Hey, hi, this is Gautam. I'm back. So in this video, I'm going to walk you through my equity research report on HDFC AMC. I'll have this report put up on the website. So I do not intend to train you through all the details in this video. I'll try to keep it short. And before I get started, a couple of things that one is that I will not be giving any one-year target prices in this report, which is really against the traditional way equity research has been operating. Because I don't believe in one-year target prices. What I'll give you instead is the annual return that one could expect over the long term, right? And in the investment thesis, I have a backup the envelope calculation, which hopefully explains, will be able to explain it to you as to how I came up with that return. Okay, and the rest of the report really is supporting backup to my investment thesis. All right. And the second thing is that I'm not a SEBI-registered analyst, so please do not treat this as investment advice. Please do your own due diligence or consult your financial advisor before you make an investing decision. All right, that's it. Let's get started. Now, how I kind of structured this report is first I have the company description, then I have the summary of my analysis, then I have the investment thesis. Okay, and if in case someone really is busy, then they don't have to go through the entire report in the first go. They can just go through the highlighted points in the investment thesis and come back later. Okay. And then I have a section on the industry, and then I have the financial performance of this company, HDFC AMC, and its valuation. All right. So let me first start with the industry. Okay. So mutual fund is at 19% of GDP in India. Penetration is at 19%, which is against the global average of 60%, which is quite low. And then emerging markets are also quite better off in terms of penetration. Okay, and the overall mutual fund AUM in India has touched close to 39 trillion. Okay, as of Feb 2022. And in this chart, I've given the growth rates of different asset categories within mutual fund. So you would say equity has been the fastest, ETF has been the fastest growing category, but the challenge is that mutual funds don't make a lot of money on ETF. They have a very low yield. And ETF has grown at 25% and liquid income at 13 and 10% respectively over the last 5 years. That's from FY16 to FY21. Okay. And equity has the highest yield. So mutual funds make money in active equity, right? And throughout the video, I'm going to say active equity and equity. So when I say active equity, what I mean is that equity minus the passive component, which is ETF. Okay, so that's what active equity is. Okay. Now here's the mutual fund composition. So you would see equity has been rising in composition from 31% to 48%. Well, this is expected, but this is closer to the Feb 2022 composition, right? Similar story with ETF as well, 2% to 13%. And then income and liquid, they have been on the decline. Okay. Now let's talk about how do mutual funds make money, which is very important. Okay. So mutual funds, they are permitted to charge certain operating expense for managing their schemes, such as sales and marketing, advertising, admin expenses, transaction costs, investment management fees. Now, this is as a percentage of the fund's daily AUM. This is important, daily AUM. Okay, I'll get back to it as to why it's important. You know, that it's as a percentage of daily funds daily AUM. All right. And all these costs running and managing these mutual funds, they're collectively managing and running a mutual fund scheme is collectively referred to as TER, or total expense ratio. I'm sure you would have heard about this a lot. Okay, and this is calculated as a percentage of scheme's net asset value. Okay. And why the MF composition is important. And again, this is something which I've kind of covered in my valuation. I have treated all the asset classes separately and projected them out to the future. Okay, so because see, valuation is dependent on, and valuation and the earnings is dependent upon this MF segment composition, because equity has the highest yield. Mutual funds, as I said, make a lot of money on equity, and then ETF has the lowest yield. Right now, ETF, I think they make around 4 BPS, I think 0.04% on ETF. Okay, because it's a passive investment segment. And this business has tremendous economies of scale. Why do I say that? Is because let's say that if you have a mutual fund scheme and you have active equity AUM of 5,000 CR, and the yield or TER on that is 1%. So you're going to make what, 50 CR, let's say, 1% multiplied by 50,000, it's 50 CR. Now, if what happens is that the active equity AUM increases to 50,000 CR, so mutual funds, they're going to make close to what, 500 CR now. Okay. So what has happened is the AUM has increased, the earnings, the income has increased, but what about the cost? Okay. The cost, they're not going to increase in the same ratio. They're not going to increase linearly. There may be a slight increase, but not that much. I'll tell you why. Because see, if you have a mutual fund manager who manages 5,000 CR worth of AUM, same manager, he or she could manage 50,000 CR as well, right? So they're not going to hire additional people to manage that 50,000 CR. That doesn't happen that way. Okay, but yeah, there may be certain expenses related to marketing and sales, because you have more people pouring in money. There may be certain expenses. That's why the expenses would not kind of rise linearly. Okay, as mutual fund AUM they scale. Okay, and one thing also to note is that I know I said that they will make perhaps same 1% yield on 5,000 CR and 50,000 CR. What happens is that the yield kind of decreases to say 0.9. I'm just taking hypothetical numbers right now. The yield decreases slightly because SEBI understands that they have tremendous economies of scale, so it doesn't let you kind of charge the same yield with rising AUMs. Okay, that's one important point to note. Okay, now let's talk about the key challenges and trends in the industry. Okay, before we go on the investment thesis. Now, equity yield pressure. Now, mutual funds, they have been facing a lot of equity yield pressure. Now, I know I said 1% they make, but actually right now the yield is 70 BPS, 70 basis point, which has kind of dropped from 80 plus historical BPS. When I say 70 BPS, I mean 0.7%. Okay, so 0.7%, whatever your AUM is, AUM multiplied by 0.7 is what you make from equity AUM. Okay, and why has it been falling? There are two reasons. One is because of NFOs or new fund offerings. You must have heard about NFOs a lot. A lot of these new players and all the existing players are launching new funds, and they're not. They don't have these NFOs. They don't have high TERs. Okay, because they are in fact there is intense pricing pressure on these NFOs because every fund is trying to attract more investors. That's why they are kind of pricing it low. Okay, that's one. The other thing is that fresh flows into existing fund, the fresh flows they come at lower yield or lower margin of 30-40 BPS. This is as per the earnings call of HDFC AMC, that the fresh flows are coming at a lower margin, because I'll tell you the reason why. Okay, now see, whenever you have fresh flow coming into a mutual fund scheme, it doesn't mean that all the flows will come in the first Jan of every year, because the fresh flows would come at different points in the year. Okay, and plus you will have redemptions as well. And remember the point that I made a couple of minutes back is that how do mutual funds make money? They make money as a percentage of daily AUM. Okay, so now if all the money that's pouring, it doesn't come the first day, it comes at different points in the year. So obviously you're not going to make that the exact same TER. You're going to make less. Okay, so that's why. And when the gross flows are substantial, they kind of drag the overall yield, and when they become a material part of the outstanding AUM. So these are the reasons why the active equity yield has been falling. Okay, and obviously if competition increases, and then there may be more pricing pressure from the NFOs and it may fall more. But so it remains to be seen. Okay, then. Move towards passive investments, which I already covered, that ETF and the index, they have been the fastest growing segment. Okay, so that's again obviously because mutual funds, they don't make a lot of money from passive, they make money from active. So again, this is a challenging trend. And then third is move towards stock picking. Now I'll recommend that you kind of go through this. What I've written here, because I've taken this is an extract from the earnings call of HDFC AMC. By the way, if you want to learn about the industry, you should actually read all the earning con calls. Okay, they are a tremendous source of insights. Okay. Now, so what essentially the point that they're making here in this move towards stock picking is, see, when COVID happened, there was a market fall, and then suddenly the market kind of spiked up like anything. So a lot of newbie investors, they kind of jumped the ship to make a quick buck, and they did make a lot of money, right? So, and it is believed when they'll kind of have their fingers burned, hopefully it doesn't happen, but if they have their fingers burned, then what will they may realize that, hey, let me kind of instead just focus on my job or my profession. Let me park my money with professional money managers, right? So that the trend may reverse. Okay, but right now this has been a challenge, and you just go through this data point that I have over here. Okay, the next, this is not a challenge investment to fintechs. This is more of a trend. I think a positive trend is because one is that a lot of new people, newbies, millennials, they are kind of parking their money in this fintech only players. Okay, which is a new distribution channel for these existing incumbents on these new players. Okay, so you're kind of increasing the industry share, industry size, because of these new players. They are kind of coming through fintechs. And then the last point is B30 under penetration. There are two things. One is B30, the other is C30. What they mean is C30 is top 30 locations, which historically has been the main source of AUM, which is the main source of AUM contributor. These are top tier 30 cities in India, and then we have B30, which is beyond 30 beyond the top 30 cities, or tier 2 or tier 3 cities, and they are still very underpenetrated. 17% of overall AUM comes from B30, 27% of equity AUM comes from B30, and this market share has been more or less the same over the last few years. Okay, so they are, B30 is underpenetrated, and SBI has the highest share from B30 at 21%, and HDFC AMC is a distant second, right? So this is this could be the next pair of growth from where the growth comes from for HDFC, AMC, and other players. Okay. Now let me go straight to talk about. Now I know I'm skipping a lot of things. Let me just straight talk about HDFC AMC now and my investment thesis. Okay. So right now, HDFC AMC is the third largest mutual fund company in India. SBI is number 1, and then you have ICICI Prudential Mutual Fund. Okay, and this is in terms of the assets that they manage. And HDFC AMC has an overall market share of 11.7%. Okay, and this is as of last month, Feb 2022. All right, and the industry AUM overall has grown at 21% from FY26 to 21, 5 years, and HDFC AUM overall has grown at 19% the same period, so 2 percentage point lower. Okay, from the industry. And then the active equity, which I just spoke about, active equity has grown at 25% in the same period. Industry active equity, and HDFC AMC active equity AUM has grown at 22% in the same period, so 3 percentage point lower. Okay, just keep in mind. And then both the industry AUM and the active equity AUM, they are supposed to, in fact, more than double. Active equity will more than, as per my projections. And again, I have given the reasoning of my projection in this report itself, which you can take a look later from my website. So the active equity AUM, as per my projection, will grow from 18 trillion rupees today to around 39 trillion 5 years out by FY27. Okay, and in the same period, as per my projections, HDFC AMC overall AUM will grow at 10% and active equity will grow at 12%, which are lower than the projected industry growth rates. Okay, because industry, as I said, is projected to grow at like 14, 15, above 15% because they'll more than double. And but HDFC, both overall AUM and active equity will grow at lower than below the projected growth rates, industry growth rates. Okay, and based upon my discounted cash flow modeling, HDFC AMC, the fair PE is 33. Okay, and which is very close to the P that was trading when I did this valuation on 11th March 2022. And if this is the fair PE at which HDFC AMC trades 5 years out, then the minimum return that you would expect is 9 to 10%. All right, that much you could expect over the 5 years period, or even though they may not kind of grow as per the industry, they may kind of grow slightly lower, but you could expect 9-10%. All right. Now let me just walk you through the my investment thesis. Okay. So again, I've used rounded numbers here just so that it's easy to understand. So it makes reading easy and makes understandability for the ease of understandability and readability. And so HDFC AMC, they right now they have an active equity AUM, or as of December 2021, they have an active equity of 2,000 billion or 2 trillion, which is 2 lakh crore. Okay, this is around 11% of the market share. Okay, and market share has been coming down. Okay, and whereas the industry active equity is at right now, it's at what 18 trillion or 18,000 billion rupees. And as I said, it's expected to grow at 15-16% CAGR and go to 39,000 billion over the next 5 years. Okay. Now, if the market share of HDFC AMC, okay, market share decline continues from 11% today to 9%, say 5 years out, okay, then the HDFC AMC active equity AUM by FY27 would be closer to 3,500 billion. Okay, so basically what you do, 9% times 9% into 39 billion. So right now HDFC AMC has what 2 trillion or 2,000 billion rupees worth of active equity. So it will go from 2,000 billion to 3,500 billion. That's an net addition of 1,500 billion over the next 5 years. Okay, so this is the amount of active equity that they will hold 5 years out. Okay, now as we covered already, the industry level yield on active equity is 0.7%. Okay, so how much are they going to make in revenue? They're going to make what 0.7 into 3,500 billion. That is around 2,450 CR. That's the revenue that they're going to make from active equity alone. Okay. Now, last 2 years, the active equity revenue has been slightly over 70% of the revenue from all the other asset classes, right? So in order for us to kind of project out at a high level, I know this is like very high level. The detail is there in the backup. So I'm right now I just want to make it simple for you to understand. Okay. So in order for us to project HDFC AMC revenue by FY27, what we do is we just this 2,450 CR worth of revenue from equity, we divide by 70%, and the total revenue that they are expected to make 5 years out is 3,500 CR. Okay. Now, this is their revenue projection. Now, profit after tax, PAT has dropped to 57%. Okay, this year, and this was like 60% plus in the last 2 years. And the reason why it has dropped is because of employee expense. They've given a lot of ESOPs. You're launching new fund NFOs, then there is some business development expense as well. And then there is DNA, because DNA has risen because they have done some capex. So that's why DNA has increased. So if we project out profitability by FY27, as per my projection, the profitability say will rise from 57 to 58% in 5 years. So 58% times revenue. So overall PAT that they can make is what, around 2,000 CR, 2,030 CR. Okay. Now, as per my DCF modeling, their fair PE is 33.3 to be precise. 33 times this PAT. Okay. So this gives a fair market cap of around what 68,000 CR. Okay. 33 times the earnings. All right. So it'll give you the fair market cap, which is 68,000, which is 5 years out. Right. Right now, as of this date, when I did the analysis, the market cap was closer to 46,000 CR. Okay. So there'll be an incremental 22,000 CR market cap addition in 5 years. Okay. Which is a CAGR of 8%. Right. And the historical dividend yield is at what, closer to 1.5%. And I've projected a dividend yield based upon historicals at 1.4%. All right. So when I kind of add these two together and taking care of rounding, so the annual return over the next 5 years is this 8% plus dividend yield, it's around 9.5%. Okay, over the next 5 years, right? So if you get in at this price, okay, then you could make a return between 9 to 10%, okay, based upon this analysis, right? And again, their market share has been in a decline, and even they have been struggling to attract investors, unique investors as well. But now they are doing a lot of things to arrest that market share. They are addressing their product gap by launching, sector-specific funds, and I've kind of covered this in the report as well. Sector-specific funds and thematic sector-specific funds and international funds, which again is an area of growth. And they're also launching a lot of ETFs as well, and dynamic asset allocation funds also they are launching, right? And they also had while recently an aggressive marketing campaign to kind of bring more investors, right? So so guys, this is my analysis. This is my analysis and this is my valuation on HDFC AMC. And again, at the risk of repeating myself, I'll have this report put up on my website and you can take a look at it. And before that, just one more point I wanted to make. The valuation that I know I didn't touch on my DCF valuation at all. I just spoke about the summary, the conclusion that I made from the DCF valuation, not the valuation itself. So here I've kind of projected out their P&L, I've projected out their balance sheet, their cash flow statement. And to the extent possible, I have given my reasoning behind each and every line item as to why I have made this projection, how I came up with this number. Okay. Obviously, I can't, even in this report, I can't kind of give all the details. And that's not the intention of any research report as well. But to the extent possible, I've tried to give my rationale and reasoning, okay, as to how I came up with a certain number. Okay. And okay. All right. So guys, hope you kind of enjoy reading this, and let me know if there is any feedback or any criticism. I'll be happy to address that. And this is the first video in this series. And when they come out with their new earnings call, I'll have another video put up, and I'll also have a new company next month. All right. So thank you. Thanks for watching, and well, appreciate it, support in the form of like or share. Thank you.